All right, in this lesson, we're going to talk about a small topic, excess of investment cost over the book value of the investee. So what we're saying here is the investee is worth X amount of dollars, but we as the investor like what they're doing. Maybe they are showing consistent growth in their income, and maybe they're showing consistent growth in their customers. So we're willing to pay more than they're worth for the investment in them. And so how do we report that? Now, from an equity method standpoint, we don't make any different journal entries than we talked about in the journal entry lesson, okay? But I want to go through this so you kind of understand what your book might be talking about when it says, okay, this investment we're paying more than it's really worth. What do we do with it? Maybe we're making internal calculations and journal entries for inside purposes so that we can allocate or reallocate some of this excess amount that we paid for it. So here's an example right here. Let's assume that our business that we're buying or the investee is worth $3 million. Now how do we get to $3 million? We get it from just like, well, where do we get the net asset of a piece of equipment? Well, we take total cost minus accumulated depreciation, gives us book value. That's kind of like what we're doing with an investee. We're saying, what's their total asset and what are their liabilities? If we subtract that out, what's their equity amount? That's how much they're worth, okay? Because at the end of the day, they might have $1 million of assets, or in this case, let's use $10 million of assets. They may have $10 million worth of assets, but if they have $7 million of debt, then really we're only buying an organization that's worth $3 million. Why? Because if I were to sell all their assets, I would get, let's say, $10 million, and then I would have to pay all of their liabilities off. Therefore, I'm paying off $7 million of liabilities. What do I have left? $3 million. Therefore, I shouldn't pay more than $3 million for that organization. Now, I know that's a very simplistic answer. Some people can refute me and say, well, if they have $10 million in their assets, that doesn't mean that you're going to get $10 million because their assets are undervalued. Get it, okay? So let's say we pay $3.5 million. Now, why will we pay $3.5 million? Well, we might pay $3.5 million because their assets are undervalued. Therefore, we're paying the difference between what they are valued in the books to what they're valued in the industry or fair market value, okay? So maybe they are undervalued. Maybe we're paying more because we like what they're doing. Maybe we're paying more because we expect increases in net income. Therefore, that net income kind of offsets our investment into them for more than they're worth, okay? So $3.5 million, now we have an excess of $500,000. What are we going to do with that $500,000? Now, again, this is a small subject in confines of the equity method. However, we don't change the journal entries that we've done in the journal entry lesson. So the question becomes internally, what do we do with this excess of $500,000? And we have two things that we can do with that excess. The first thing that we can do is allocate it to those undervalued assets, okay? Undervalued assets, let's assume that they have an equipment. So this is the investee, okay? Not the investor, the investee. Investee, okay? Let's say the investee had equipment on their books for $70,000. That's their book value. But when we do an evaluation analysis on them, we're finding out that that equipment is worth $100,000 in the fair market for it. So we notice that there's a $30,000 difference there. So what we could do is allocate some of this $500,000 to the difference between the book value and the fair market value of that equipment. In this case, $30,000. Okay? We can do the same thing with land. And this is typically a problem. We buy land, we put it in our books at cost, we hold it for 10 or 15 years, and then the value of that land goes up. Very real situation. So $500,000 in the books, we reevaluate it, it's worth $800,000. Therefore, it is different by $300,000. Okay? So then we can allocate more of this $500,000 to this $300,000 difference between the fair market and the book value. Okay? So at the end of the day, what happens? We have $330,000 that we could allocate because these are undervalued assets. Okay? That leaves us with $170,000. Now, what do we do with the $170,000? Again, remember, internal entries only, not necessarily the equity method. but this is in this chapter. So what do we do with the 170? The 170 is what we call goodwill. Okay. Now, goodwill is the amount of excess we paid over book value of the organization. In this case, we've singly said that of this $500,000, $330,000 is because of the undervalued of that. The rest is goodwill. This is what we paid in excess of the book value, and in this case, the in excess of the things that we haven't already allocated. Well, we already allocated $330,000. We haven't allocated $170,000, so that's goodwill. In financial accounting, or sometimes intermediate accounting, when we talk about goodwill, we revalue this every single year for impairment. So that's what we do there. Again, the journal entries when it comes to the equity method doesn't change, so we would still debit the investment in X Corp by $3.5 million. We would credit cash or stock, whatever we give to them in order for us to acquire that corporation at 3.